The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hi everyone. In today's interview, I'm thrilled to be interviewing Bob Ciura, a Senior Vice President at Dividend, the company that backs the Sure Investing Podcast. Bob has an MBA from the University of Notre Dame and spends his time performing fundamental, bottom-up equity research on dividend stocks for Dividend's website, publication partners, and premium investing newsletters. In this interview, we discuss Bob's investment due diligence process, his thoughts on why dividend stocks outperform, and the characteristics that he believes make an outstanding long-term investment. Stay tuned for more. I just wanted to begin by taking some time to thank you, Bob, for being interviewed on the Sure Investing Podcast. No, the pleasure's mine. I thought we could begin by just asking, when was it that you began to be interested in investing, and how did your journey as an investor begin?
Well, I first started to be interested in investing when I was in college. I changed my major about halfway through to finance, and I did that because I thought that it would be a better career choice for me. And as I advanced my studies, I became a lot more interested in the stock market. And then I began investing pretty much right out of college. So I believe I bought my first stock when I was, 22.
Do you remember what the first stock you bought was?
I do. It was Altria Group, which is the old Philip Morris.
Now that's been one of the best. That's been one of the best performing stocks I think of all time. If you go back over, say, like a 30+ year time period, so that's very interesting that was your first stock. Definitely a great choice.
Yes, and actually, perhaps the biggest reason why I bought Altria was because I had read Jeremy Siegel's book, The Future for Investors: Why the Tried and True Triumphs Over the Bold and the New. And in that book, he discussed how from 1925 to, I believe, 2003, like you mentioned, Altria was the best performing stock, which was such a shock to me because, there's kind of a perception that in the stock market, in order to produce market-beating returns over time, you have to take huge risks. And his book really kind of disproved that and showed that what really drives returns over the long term is earnings growth and then reinvested dividends. And that's sort of sparked my interest in dividend investing.
Now, would you say that from the beginning you were predominantly a dividend investor, or has your investment philosophy changed over time?
My investing philosophy has kind of changed the same. I've always been attracted to dividend stocks and value investing. The research has been pretty consistent over time that dividend stocks, particularly those like the dividend aristocrats that we write about every day and that raise their dividends each year, significantly outperform the overall market.
Yeah, definitely. Going back to your college days, you mentioned that you changed your major halfway through. I'm curious as to whether you were something completely different, like, say, a biology major or an engineering major, or were you always interested in business from the beginning?
You actually got it right. I was a biology major because I thought I wanted to be a dentist, but that just really was not where my area of interest was. And so I moved into business because I thought it would just be a better path for me. And as I say, the rest is history.
That's super interesting to me because I had the exact same experience. In my first year of college, I was doing biology as well. And I just really didn't like it. I wanted to be a doctor.
No kidding.
What's that?
Okay, wow. I just said no kidding because that's such a coincidence.
Yeah, it's hilarious, so it's really funny. It's really amusing me. And I did a year of biology, and I hated every second of it. So I basically went to the academic advisor for that department and said, I don't like biology. I like numbers. What can I switch to that will still allow me to graduate on time? And that led me to switching to a double major in math and stats, which is not super applicable in the business world, but I definitely enjoyed it a lot more than a biology degree, that's for sure.
Yeah, I totally agree. I didn't really much enjoy it either. I hated the labs, and so it just wasn't a good fit for me.
Yeah, definitely. Now, speaking to someone with more formal business training than I have, would you say that you've noticed that there's a wide divergence between stuff that actually works in the real investing world versus the things that they teach you in conventional academic financial theory?
You know what? I do think there's a difference. In school, it's very academic, obviously, so you learn all the formulas, you learn time value, and you learn, how to use the cash flow register on your financial calculator and you go through discounted cash flow. When I started to invest in the real world with my real money, I quickly found that a lot of those models are based on assumptions, and you can trip up pretty easily if you are overly aggressive in what you assume in terms of a company's future growth rates and how you discount that back to the present value. And so I learned kind of the hard way early on, as I'm sure many other investors did, that the old saying applies: garbage in, garbage out. So if you're too unrealistic about your projections, then things don't go very well. And so I found that value and dividend investing was just far more effective in my case.
You mentioned having to learn the hard way that those types of models don't necessarily work in practice. Is there any one particular investment or one particular learning opportunity that you think would be worthwhile to share with our listeners?
Well, I bought a few stocks right before the Great Recession hit, because that's when I was just starting my investing journey. I can't really remember what those were, but a lot of them were kind of the high-flying tech stocks of the day. Not many paid dividends, and my Altria stock pretty much destroyed them all in comparison, especially through the Great Recession and even afterwards. And so that kind of reinforced the lesson of value and dividend investing, and that the slow and steady, as Jeremy Siegel wrote, kind of tends to outperform all else.
I completely agree with that. Now, thinking about good investments, solid core holdings in your portfolio now, I'm curious to hear about your investment due diligence process and what you would recommend, what strategies you would recommend that our listeners follow if they want to find compelling and conservative and safe long-term investment opportunities.
Sure, of course. Well, I think before anyone buys any stock, it's critical that the investor understands what a company does, its business model, how it makes money, the products it sells, who its customers are, and just as importantly, who its competitors are. You really have to get a good idea of what the company does, because I think there's a tendency to view stocks as just sort of gambling chips at a casino. But that's really not how it works in the real world. And so understanding a business through and through is the first step. And I think reading through a company's annual reports, their SEC filings, the 10K, the 10Qs, going through their investor presentations, listening to conference calls, going through their earnings releases, all of that is really critical to the fundamental valuation process. Now, once that is done, I think the best investment opportunities are companies that are profitable, have strong brands, have growth potential, because obviously you don't want to get sucked into value traps. You want to, 30 years from now, but will have made more money over the long term than they do today. I look for strong balance sheets and strong economic moats, which is a term that was popularized by Warren Buffett, which describes companies that have competitive advantages that can last over many years. So just in a nutshell, I guess those would be a few of the key themes that I focus on.
You mentioned the concept of a competitive advantage or an economic moat, as Warren Buffett puts it. And I can tell just from the writing you do at Sure Dividend and the way you approach investing that it seems like his approach has had a pretty big impact on the way that you approach investing. Are there any other kind of mega super investors or, high profile institutional investors that have had a big impact on the way that you invest your own money?
Yes, absolutely. Seth Klarman is someone that we follow very closely because he's a very famous value investor and he sticks very rigidly to those core value investing principles. I'm also a big fan of Peter Lynch, although he's obviously no longer a manager. His book, One Up on Wall Street, is a book that I would recommend to anyone who's interested in buying individual stocks. And he was, of course, the former manager of the Fidelity Magellan Fund, which was such a strong performing mutual fund during his tenure there. So those would be some of the high profile investors that I've learned a lot from their work, and I employ those practices every day.
Good to know. Thanks for sharing. When it comes to your due diligence process, which we talked about later, Would you say that which we talked about earlier, would you say that there's a particular financial statement or financial metric that you tend to rely on heavily when doing your due diligence?
Absolutely. My favorite financial statement is the statement of cash flows, which can seem similar to the income statement, but has a very important difference, which is that earnings per share, which is at the bottom of the income statement, can be managed by executives and management at a company. They can, take charges against earnings or exclude things to come up with an adjusted earnings figure. And that can be a little misleading at times. It can kind of skew the image of how a company is really doing. Whereas the statement of cash flows can't be faked because that focuses purely on the cash in and cash out of a company. And if you are to calculate free cash flow, which is just the operating cash flow minus the capital expenditures, you really have a very pure and true sense of how the company is performing from a cash flow perspective, which in my opinion is more important than earnings per share.
Do you think that free cash flow is still a highly useful metric when it's applied to companies that have very capital-light business models, like, say, maybe an insurance company or a technology company?
Not in all cases. No, I do agree that in some cases, statement of free cash flow, it might not be the best metric to use when evaluating a stock because, like you said, certain industries like insurance companies, they're not going to show huge levels of free cash flow. So in those instances, there are exceptions to every rule. And so for an insurance company, looking at the balance sheet and the income statement might be better. But I think in most cases, cash flow does tell the story.
Yeah, I can definitely appreciate that perspective. The ultimate goal of any rational investor is to generate a stream of cash flow for themselves from their investment portfolio. And you really can't do that unless your investees are generating cash flow of their own, which they can send back to you.
Agreed.
Now, speaking of dividends and cash flow and passive income, what's your opinion on share buybacks as versus dividend payments and other capital allocation policies? Do you have a preference? Would you rather your investees buy back stock or send you dividends?
My personal preference is for dividends. I like to get paid real cash. That being said, I do see merit in share buybacks because when used properly, they can grow a company's earnings per share and they offer a tax advantage status over dividends. As you know, stocks that pay dividends to shareholders, not only does the company pay tax at the corporate level, but then the investor pays tax on the dividends. And so dividend stocks succumb to double taxation, which provides share buybacks with an advantage. The one caveat to that is when share buybacks are not used appropriately, in my view, which is when companies will issue share buybacks only to offset the dilution from share-based compensation. In other words, some will award huge amounts of stock options to their management team, and then they'll have to spend a lot of cash flow to buy back shares to offset the dilutive impact from that. So that's an instance in which I don't favor share buybacks. But in all else being equal, I just tend to favor dividends because dividends can't be faked. It's real cash going in an investor's pocket, which for many investors, such as retirees, can do so much good for them by allowing them to spend that money on maintaining their lifestyle, paying for necessary expenses, whereas you can't really do that with share buybacks.
I have a company in mind when I ask this question, so I'll share my answer after. But I'm curious, are there any companies that come to mind right now as examples of companies that are buying back their own stock when it is irrationally overvalued?
Yes. Well, there's many instances of that, and that's a great point. That's another reason why I'm slightly skeptical of share buybacks is that you'll notice share repurchases tend to be conducted at the wrong time. Share repurchases tend to increase quite a lot when the markets are running up like they are now, which does make sense because companies have more cash flow available to buy back stock when the economy is good and profits are up. But nevertheless, they do tend to buy back shares after their share prices have gone up quite a lot. And then during economic downturns, when their share prices are much better bargains, share buybacks tend to dry up.
So are there any examples of companies doing that right now that you'd like to share with our listeners?
Well, I would say, obviously the technology industry is a huge area where share buybacks are prevalent. But even within technology, you can find companies that are doing it well, and those are the ones that I would tend to favor, like Apple, for example, or IBM is another company that has steadily reduced its share count over time. So, I think in any industry, you'll find companies that are doing it properly and others that aren't, and the ones that aren't are the ones that you want to avoid. I don't have any specific stocks off the top of my head, but I'm sure that we've run across them before in our research.
Yeah, definitely. One that comes to mind for me, and I actually haven't looked at them in a while, so maybe it's different now, but McDonald's stock I think is a little bit overvalued, and the company's still aggressively buying back stock, which I don't think is probably the best use of their shareholders' money.
I would agree, and it's disappointing almost because so many of the dividend aristocrats, of which McDonald's is one, seem to be at least fairly valued, if not overvalued. And so, with the markets having run up for virtually the past decade uninterrupted, it's just a lot harder to find stocks that are still attractively valued. And, the economy is doing well, so there's strong profitability for most blue chips, and that's why they're buying back so much stock. But like we've discussed, at these prices, they're probably not getting a great deal on those shares that they're buying back.
Yeah, definitely. So we understand now that you prefer dividends over share buybacks, which makes sense. What are your thoughts on special dividend payments?
I like special dividends. I think any dividend is a good dividend. Special dividends are great. I happen to own some Ford stock, and they, a couple of years ago, instituted a policy of paying a special dividend each year when their profits are strong enough to justify a special dividend. And it can be kind of a nice cherry on top of the sundae, each year to have a little bit extra dividend coming in. So I certainly don't have a problem with special dividends.
I'm not familiar with Ford's special dividend policy, actually. So how much, I'm curious, I know that's a relatively high yielding security already. How much additional yield would you receive as a result of those special dividend payments?
Well, it depends on how much they pay. I think last year Ford's special dividend was $0.05 per share, and this year it might be 10 cents, although I would have to double check on that. But let's assume that it's 10 cents this year, with their stock price around $10 a share, it's about an extra 1% return. And as you said, it's already such a high yielding stock. The dividend yield from the regular dividend is over 5%. So, you're looking at a total yield of about 6.5%, I think, this year, based on where Ford stock is currently trading. So it's very attractive for anyone who appreciates or desires income from their investments.
Yeah, and for anyone who's unfamiliar with the Ford investment thesis, one of the big reasons why they're able to trade at such a high yield without paying out an unsustainable dividend is because their price to earnings ratio is just absurdly low. It's in the single digits. I think the last time I checked, it was around 5 or 6 times earnings, which is just unheard of for such a blue chip company.
Yes, it is, and GM is about the same valuation. GM has a bit lower of a dividend yield than Ford, but they're both trading, as you said, with very low PEs in the mid-single digits.
Yeah, definitely a unique investment proposition there. So we've talked a lot about on this call so far about when to buy a stock. And you mentioned you like looking for companies that generate gobs of cash flow and return those cash flows to investors and have business models that are generated by strong brands with high margins and loyal customer bases. The opposite of buying a stock is selling a stock, and that's the other component of portfolio management. In your opinion, what are the key signs that an investor should sell a stock?
Well, there's 3 things that I would look for if I were ever to decide to sell a stock, and I have sold some stocks occasionally. The first thing I would look for is if a dividend is cut, and that has an obvious implication for investors is that you will lose out on a lot of the dividend income that you had been receiving. And the other part of that that's unfortunate is that when stocks cut their dividends, they usually will see a huge drop in their share prices as well. So a dividend cut is usually grounds for dismissal, as far as I'm concerned. Another instance would be if the business model is broken. If the fundamental case that you had for buying a stock is no longer there. For example, if a company has a huge acquisition that seems to be a bad acquisition and a waste of capital, or if there's some sort of a scandal or an accounting scandal, for example, or change in the management structure. Anything that causes the reason why you bought the stock in the first place to be no longer true could be reason to sell. And the last reason for me would be extreme overvaluation, which is a good problem to have, because that means that you've bought a stock at a fairly low price and it's gone up a lot, and now the valuation has gone ahead of where you personally believe fair value should be. And that's one of the principles that we use very strictly in our analysis of stocks. And for example, if a stock is trading at about 150% or more to our estimation of fair value, it's now a sell candidate. And the reason for that is to protect your profits, to harvest those gains before the valuation adjusts back lower. It's pretty simple when you think about it. It's buy low, sell high. And so those three principles are the considerations that I think about if I'm thinking about selling a stock.
Now, your last sell criterion, which I completely agree with, by the way, it sounds like you're basically trying to avoid bubbles within the stock market. You're trying to sell things when they're irrationally overpriced and reinvest those proceeds into opportunities that just make more sense. When you look around today's stock market, do you see any individual securities or baskets of stocks or even sectors that you would say are in a bit of a bubble right now?
Oh, well, sure. Yeah, I definitely think some of the large cap tech is in a bubble, if not close to it, particularly with the internet stocks. Amazon, Netflix, Facebook, they've been popularized as the FANG term. They trade for huge valuations, in some cases over 100 times even forward estimates. Obviously, they don't pay dividends, and they might never. And in those cases, I think investors buying at these levels could be setting themselves up for pretty poor returns going forward, because even if those companies continue to grow at a high rate, and they probably will, they have to grow at such a high rate to justify their valuations that returns could be quite low, even if they continue to grow. And that's what we saw in the late 90s in the dot-com bubble, is that stocks like Cisco, for example, or Microsoft, their market cap soared above 500 billion in some cases. And they had to spend the next decade sort of growing into those valuations. And so investors who had purchased those stocks in the late 90s generated returns of almost zero, and in some cases negative returns. And it's not because the company did poorly, as I mentioned. The company itself continued to grow, but they had to grow into those valuations. And so that's something to watch out for. I think in other areas of the economy, in other sectors, industrials are a bit of a concern. There's a group of dividend aristocrats from the industrial sector that are very strong businesses. They have great products and strong industry positions and competitive advantages. Stocks like 3M, Emerson Electric, Dover, Illinois Tool Works. They're very strong businesses, but as we've written repeatedly about them, their stock prices just aren't priced attractively enough to buy today, because they're trading at price to earnings ratios, I think, near 30. And they will continue to grow earnings, probably in a high single digit to low double digit range. But the risk of the contracting valuation multiple is so severe that even if they continue to grow earnings and pay their dividend yields, total returns could be quite poor. And so the industrials would be a group that I'm slightly wary of right now.
Thanks for sharing. That was actually super interesting, because if you were to ask me the same question, I would have echoed your thoughts about the technology sector. And I agree with your thoughts about the industrial sector. It just wouldn't have necessarily come to mind for me, but you're definitely right there. Those stocks are trading at valuation multiples that probably don't make sense relative to how fast they're growing right now.
Yes, I think so. And also, when you look at their historical valuations, these stocks are trading at price to earnings ratios in the mid-teens. Not that long ago, just a few years ago, and now their valuations have gone up far in excess of their earnings growth in some cases. And so that's a dangerous sign to look out for.
Yes, definitely. I'm going to flip that question on its head and ask you basically the opposite question. Where in today's stock market do you see the greatest opportunity for investors?
Well, that's a tough question because value is really hard to find. You know, with the S&P 500 on average trading for a price to earnings ratio above 25, it's really hard to find any areas of the market that are really undervalued. I do think there are pockets of value that you can still find. I think the energy sector looks pretty good right now after having suffered a few really bad years with oil and gas prices plunging since 2014. There are still some really strong stocks like ExxonMobil and Chevron that have pretty modest valuations and strong dividend yields of close to 4%. I think pockets of retail still look attractive because retail has suffered so much in the last few years as Amazon looks like it's taking over everything. So that's kind of compressed valuations there, and dividend yields are a little higher as a result. So there are still pockets of value. I think healthcare looks pretty strong, although valuations are definitely higher in healthcare. But I think those valuations are justified for stocks like Johnson & Johnson or Pfizer. They're not the cheapest stocks around, but they have such strong long-term growth potential because we're in an aging society and demand for healthcare is only going to grow probably at a rate that's faster than GDP in the U.S. and they have strong yields. So in that situation, I think it's still reasonably priced. But outside of that, like I mentioned, I think it's really challenging to find value right now.
What are your thoughts on the retail sector?
Well, retail has obviously had a hard time. Comparable sales for a lot of large retailers, particularly department stores and specialty retailers, are challenged. E-commerce is obviously where the growth is in retail. And companies are having to spend so much to compete with Amazon, and then you add on top of that that e-commerce is much lower margin. It is compressing earnings and consequently valuations. But that being said, I think the large retailers like Walmart, Target, Costco, they have entrenched themselves so deeply that they're not going away anytime soon. Their valuations are pretty reasonable in the mid-teens, I think, for Walmart and Target, and they have strong dividend yields, and they raise their dividends each year. So those stocks, I think, are still attractive.
Yeah, I definitely echo all your thoughts there. Taking a more narrow view, are there any individual investment opportunities, individual securities that stand out to you as being particularly compelling right now?
In retail or just in general?
Just in general.
Sure. Well, I think if you look hard enough, you can still find value in just about every sector. I think from the sectors that we've talked about in healthcare, I still think Johnson & Johnson and Pfizer are strong. I think Cardinal Health is very undervalued with a strong dividend yield, and it's also a dividend aristocrat. In retail, I think Walmart and Target are still fairly valued, although they're not quite as cheap as they used to be. And for investors who are willing to take a little bit more risk in retail, I think Macys is actually a pretty attractive opportunity here. Macys has been one of the hardest beaten down stocks in all of retail. I think it's kind of the poster child for what people think will happen to retail now that Amazon is taking over. But there's a lot of value to be found with Macys. They have huge real estate value on the balance sheet. They had an institutional investors of theirs, Starboard, produce a great presentation. And Starboard estimated that Macys real estate was worth at least 15 to 20 billion. And when you consider that the entire market cap of the stock is, I think, 8 billion, that essentially means they've got about twice their market cap in real estate value. And that's essentially valuing the retail business itself as though it's worthless, which it's not. Macys is quite profitable. So there's a strong case, I think, to be made for Macys. They have a very high dividend yield, I think above 6%, and a very low valuation. It's a little bit riskier, obviously, because they don't have the same scale as a Walmart or a Target. But for investors who are willing to take a little bit more risk, I think Macys is a pretty strong value.
Yeah, definitely. I've read that institutional investor presentation from Starboard Value, and they made some really compelling points in there. I think that Macys recognizes the value of the real estate because the last time I looked at them, which would have probably been about 3 months ago now, but the last time I looked at them in their quarterly earnings presentations, management seemed extremely focused on harvesting the value of the real estate in their poor performing locations and then using the proceeds from asset sales to perform their best or to improve their best performing locations and open new stores in more compelling locations. So that's definitely a unique investment opportunity there.
Yes, I agree. And I think doing a little bit of trimming the portfolio can ultimately help, because I think the simple reality is that we became over-retailed in this country, just too many stores. And with the growth in e-commerce, a lot of retailers had to close some stores, which isn't necessarily a bad thing because, as you suggested, the remaining stores can improve their performance. Macys can use the proceeds from any asset sales to pay down debt, improve their balance sheet, and invest in new growth initiatives like Backstage, which is their off-price channel designed to compete better with specialty retailers on the discount side like TJX. So I don't think the store closures are the end of the world for Macys. And meanwhile, they're able to hold on to their prized properties like Herald Square and the others that are hugely valuable to them.
Definitely. I mean, Macys is undervalued, and you gave a fantastic list of other investment opportunities that are also undervalued. Do you have any suggestions for investors who are struggling to come to terms with buying stocks in a market that is on average so far above its long-term historical valuation averages?
Do I have any advice as far as how to get started or whether to be investing at all?
Yeah, I guess investors who are psychologically struggling with rationalizing making buy decisions when the stock market is on average overvalued.
Yes, that is a tough question. It's certainly something that I can empathize with, because you don't want to sit on the sidelines and not invest, because you can miss huge bull markets like the one that we've seen for so many years. But on the other side of it, you don't want to put your money in at the top. Ultimately, I think that being invested will always be not being invested. And I think a good strategy to try to mitigate the risk of buying an overvalued market would be to dollar cost average, to invest a set amount of money each month or each week. And what that allows for is, when the market is very high and stock prices are high, you'll buy less with that set amount of money. And then when the market goes down, you'll buy more. So it kind of helps smooth out the fluctuations. But I think the biggest takeaway is that everyone should be invested. U.S. stocks, particularly those that pay dividends and raise them each year, are the best wealth building mechanism that we have. They have far outperformed any other asset class, and that includes bonds, commodities, and real estate. So as I mentioned, I think to sum it up, being invested will always beat not being invested.
Definitely. I echo that 100%. I mean, for me personally, I am fully invested right now, even though the market is basically as overvalued as it's ever been when measured by the Shiller PE ratio. And I mean, the best advice that I have is to just keep buying.
Yes, I agree completely. And considering there's just such a lack of alternatives, there really doesn't seem to be a better place to put your money. With interest rates so low, if you put your money in a savings account nowadays, I mean, you're lucky to earn 1.5%, which really doesn't even meet inflation. And so in real terms, if you're just putting your money into a savings account, you're losing money, you're losing purchasing power. So you almost don't have a choice but to invest, because it's really the only place to earn a decent return nowadays with interest rates so low.
Yeah, I definitely agree with that. And speaking on the topic of valuation, do you see any significant risks that you think could trigger a major stock market correction or bear market?
Well, sure. There's always risks. I think the U.S. economy is in a good place. GDP growth continues to accelerate above 3%. Unemployment is below 5%. The housing market is strong. So there's a lot of positive indicators. I think the biggest risk would be, number one, overvaluation, which is in itself can be a risk. If the markets are simply overheated and priced too far above the likely earnings growth of the S&P 500, share prices could suffer. I also think rising interest rates is a risk, and we've seen that in the past couple of weeks with the dramatic volatility that we've seen in the markets. Rising interest rates make borrowing more costly, and for certain asset classes like REITs and MLPs, that's a particular issue. So I would be wary of stocks that don't have strong balance sheets, that are very heavily indebted and highly leveraged, because rising interest rates will particularly impact those companies. It will raise their cost of borrowing, and that can really have a negative impact.
Yeah, definitely. Those are all very solid points. You mentioned REITs and MLPs in that description, and that's an asset class that a lot of investors don't really dive into. What are your thoughts on those two asset classes?
Well, I think REITs and MLPs can serve a very valuable purpose, primarily income. They're very popular among retirees and retail investors because REITs and MLPs typically pay dividend yields 3 to 4% above the S&P 500 average, and even more in some cases. So they're great investments for income. And so those are ones that I would recommend for anyone in or nearing retirement who will no longer be able to rely on a paycheck from employment and would like to replace that income somehow.
Yeah, definitely. I mean, I echo your thoughts there 100%. I think they're a really unique income investment opportunity for investors who need that. With that said, do you have any investment that you see right now that you would classify as your favorite income opportunity?
My favorite investment opportunity? Well, I would stick with the tried and true, the dividend aristocrats. Those are stocks in the S&P 500 that have raised their dividends for at least 25 years or longer. I think for investors with long time horizons, that's the best place to generate sustainable wealth over the long term, because those are the stocks that have been proven to outperform. For different types of investors, there are other asset classes that might be better, and as we just discussed, I think for retirees, MLPs and REITs look pretty attractive. They've been beaten down pretty hard since the start of 2018 because of the risk of higher interest rates. And so you can get some high quality REITs and MLPs for pretty attractive valuations and pretty high dividend yields. So for investors who need or desire income from their investments, I think REITs and MLPs are looking pretty good.
Awesome. I agree with you 100% there. I wanted to close up by asking you one interesting and kind of profound question, and that's this. If you had one piece of advice for an investor who is just starting today, what would it be?
My one piece of advice for an investor beginning today would be start investing as early as you can and invest as much as you can, because it will well be worth it.
Awesome. I agree with that completely. Thanks so much for your time, Bob. It's been a pleasure interviewing you today.
Thank you, Nick. I had a great time. Pleasure to speak with you.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.